Congratulations on successful completion of 5 years of ICICI Prudential Flexicap Fund. If you were to describe this journey in one sentence, what would it be?
Wow, one sentence would not do justice actually. But anyway, if it was to be one sentence, it would be.
If you were to compare the portfolio back then versus now, what would you say has changed, what has evolved and what remains unchanged?
Today as we speak, portfolio is reasonably different. We are underweight large caps. We are meaningfully overweight small caps.
Are we also cognizant of valuations when you are selecting stocks?
I think growth for me is more important metric to look at. So honestly, actually valuations would come like second, maybe third or fourth in the pecking order.
As we are in a very volatile market environment currently, where are you seeing the most compelling opportunities?
Look at last 5 years.
Hello everyone. Every investment journey has a story, not just of returns, but of market cycles, investor behavior, and also the philosophy behind the strategy. Today, we are taking a closer look at the 5-year journey of ICICI Prudential Flexicap Fund, for which we have with us Senior Fund Manager Mr. Rajat Chandak today, who's been associated with the organization since last 18 years and has been managing the fund since inception. Welcome Rajat.
Hi.
Congratulations on successful completion of 5 years of ICICI Prudential Flexicap Fund. So if you were to describe this journey in one sentence, what would it be?
Wow, one sentence would not do justice actually. But anyway, if it was to be one sentence, it would be that it has been extremely challenging and at the same time reasonably satisfactory at this point in time after 5 years. Just want to dig a little deeper on why it was extremely challenging. Just very briefly, the NFO came in 2021, June, July, around that time. And this was just the post-COVID era. And markets had already rallied 30-40% in the previous 12 to 15 months before the fund was actually launched. Right. And in fact, even till October, November of 2021, the first 3 or 4 months after the NFO, the markets kept rising. I mean, they kept going higher and higher. Maybe I think they rallied another 15 to 18% since the fund was launched immediately in the next 3-4 months. So it became extremely challenging to deploy in that phase. You already had seen lower valuations few months ago, and when you had the money and when you had to deploy, even at that point in time, the markets kept on rallying. So it became a very, very challenging initial phase. And what happened was, we at ICICI Prudential are generally reasonably conservative while deploying in any NFO because we don't want our customers to have, poor experience, initial experience at least. So we were slightly cautious in that phase, and by the time we deployed, next 6 to 8 months, we all know what happened. Russia and Ukraine geopolitical conflict hit the markets, and markets actually corrected 18 to 20%. So first year was extremely challenging because you were deploying when markets had rallied, and they were rallying, and once you were reasonably deployed, the markets crashed. So first year was pretty bad actually. We lost quite a lot of alpha, but then after that, touch wood, things have been pretty okay. Yeah, so in that context, it is satisfying for me that, what the fund has achieved so far in the last 5 years.
Okay. So like you just mentioned that the markets were challenging earlier when the scheme was launched because of the valuations. If you were to compare the portfolio back then versus now, what would you say has changed in the portfolio? What has evolved and what remains unchanged?
Actually, portfolio would have changed meaningfully in my view. I'll tell why. Because one, as I was just speaking, initially markets had already gone higher. Valuations were slightly on the higher side in our view. And we went looking for safety. As I said that we have always been cautious deploying any NFO money in the initial phase. So we looked for ideas where you could see that maybe downside is limited in those investments. And we went for blue chip names, more large cap names. Small cap or mid caps would have been less than 15% or less than 20% even, maybe 10% at that point in time. So initial focus was on blue chips, relatively safer bets, slightly more comfortable in terms of where they were trading at in terms of valuation. So conservative approach initially. Once that deployment was done, in the first 6 months, 7 months. Thereafter, as and when market gave us opportunities, we did change the portfolio. It switched from those names to, how I would have typically liked the portfolio to be on day one in that context. Today, as we speak, portfolio is reasonably different. We are underweight large caps. We are meaningfully overweight small caps. As and when markets kept giving us opportunity, churned the portfolio after the deployment phase. Today, it's reasonably different.
Okay. So, at the heart of every successful scheme is a very strong investment philosophy. So, what are the key guiding principles that define ICICI Prudential Flexicap Fund?
From a very top-down perspective, I would want to say that it's a bottom-up stock picking fund. It's what I follow is a buy and hold strategy. So the churn, portfolio churn, is towards the lower end within the industry, and literally no cash calls. I think these three are at the heart of it. Obviously, there is a style with which I manage, which is slightly more growth oriented. So that is another part of it. So growth oriented, bottom up, no cash calls, low churn. These 3 or 4 are the key characteristics of the fund. We internally call it, GLOW strategy. So, there are 3 or 4 aspects which I look at while building the portfolio. G stands for growth. Growth can be driven by anything. It could be industry growth. It could be, things like industry shifting from unorganized players to organized players. So some players would be growing at a faster pace. Companies entering into newer businesses, adjacent businesses, which enhances their total addressable market, and hence they could become, much bigger companies over time. And fourth and most important actually is market share gainers. So, sometimes people ask me, well, how do you define growth? So growth, it's not a one particular number for me that, if it is growing above 15% or 20%, then it's growth for me. If an industry is growing 8 or 10% and some companies growing 12 to 14%, that is growth for me. That will also qualify as growth for me because they are gaining market share. Cyclicals would also form part of it because, different industries go through some business cycles over time. And when they are on the up cycle, they would be growing at a fast pace. So even cyclicals would fall into that bucket. L stands for leadership quality, how the management has been, how have they, executed in the past, how ambitious they are. I think that is one of the key things which I look at. Past operational performance and ambition. O is again, operational performance, something linked to, specific to market share gainers, how they have operated. W is slightly more on softer aspect. Are the promoters or the management working for all the stakeholders involved in the business? So this would mean, their suppliers, their distributors, their employees, and their customers. I strongly believe that any company would have to add value to all of the people who are in the ecosystem and obviously society at large. And in that process, they just have to be slightly efficient enough to earn a decent return on equity. So if they can add value to all the people involved and at the same time add value to themselves, which would be reflected in ROEs, I think that's a key to having a winning investment idea in my view. So call it GLOW is at the heart of it.
Okay. If you can walk us through the portfolio construction process, like when you're evaluating an opportunity, what are the 3 or 4 non-negotiable characteristics that you look for?
Things from the previous question in terms of investment philosophy. So that is very, very important. Management, growth outlook, etc. That is the starting point. Second is I do a lot of channel checks, try to get feedback from the ecosystem because as I said, they are very, very important. How the company operates. See, the CXO level guys who are running the company would most likely say good things about how they are managing things. But it's the people whom they deal with. You get a clearer feedback, maybe a more honest feedback, whether the management or company has been open to their feedback, are they fair and transparent in their dealings with them. So try to do a lot of check across the ecosystem which the company operates in. And once convinced, I would go all in, and that's partly linked to the buy and hold strategy, because once you are convinced, then you are in for it for a long period of time. So if you look at, the average holding period of the portfolio, it's closer to 4 years in that context. So, slightly, long term. Once convinced, go all in. I don't look at benchmark as much. So, the deviation from the benchmark or active share, as we call it, is very, very high in the portfolio. So, it's just bottom up, a kind of absolute return strategy you can think of, because, where I think that money could be made on a bottom up basis, you just buy and hold. So, and over time, just hope that relative performance is also okay versus the benchmark. So, that's the portfolio construction part of it. In terms of non-negotiables, I think, see, in investments, we say that never say never, because things keep changing. Management can change, industry structure can change, government policies can change. So, one statement which is very strong is never say never. But couple of things which I do keep in mind, which I would not want to negotiate in general, is past track record, execution, market share losers. That is largely no for me. I mean, that could also change if there is a management change and you have a better people, better team managing the company. Maybe that would also change, but that's a no. Second is where growth outlook is not clear. I'm not saying it's a no, but I may be hesitant in investing in such ideas. Apart from that, there is a typical thing of corporate governance. If there has been any instance in the past where corporate governance was questionable, then I would be wary. Capital allocation, if is also under question, is pardonable for, in my view, if they have not lost out on their core, business. So, they are doing very well in their existing business, but capital allocation somewhere else they did, which did not work out. That is still okay, as long as they have not lost the game in their core business. That is also okay. So, largely it's to do with, past track record and maybe growth outlook. These would be the ones which I would be wary about.
Okay. Are we also cognizant of valuations when you are selecting stocks?
Obviously, you have to be conscious about the price which you are paying. But I think growth for me is more important metric to look at. So honestly, actually valuations would come like second, maybe third or fourth in the pecking order. First would be growth, management track record, some feedback, etc. And then I'll go to valuations. So yes, you are conscious, but not like, if it is very expensive, I may not buy, may not be the scenario. You may buy some, you can do risk management by weight management. Something which you also are aware is extremely expensive. Maybe you will have a smaller weightage in the portfolio, and as and when market gives you opportunity, and markets are always volatile, right? So market always gives you an opportunity. So in corrections, maybe you add more. So yeah.
As we are in a very volatile market environment currently, where are you seeing the most compelling opportunities currently?
Yeah, markets have always been volatile, right? Look at last 5 years. You have had COVID, post-COVID, you have rate hikes, inflation, geopolitical issues, Russia, Ukraine, and West Asia crisis now, crude oil prices all over the place. So, but, always markets will remain volatile always. Where I see interesting opportunities at this point in time is, in the banking and financial space. I think valuations are attractive there for the kind of earnings growth recovery which we may see going ahead. That is one space. IT services, as I said, have been underweight, but valuations today are like very, very attractive, and I've said that recently as well. But outlook is not that clear from next 12-15 months perspective. But I think from a 2-3 year perspective, I think there's very less to lose money in the IT services as a space. I think a lot of interesting small caps are there in the market, interesting businesses which remain very, very attractive to me even at this point in time. And another small pocket, not small, a pocket which has emerged over recent past is, exporting manufacturers, product exporters, manufacturing engineering goods and products and, exporting it. I think that again is a very, very interesting bucket to look at this point in time, and it could be a good mid-term from a 3 to 5 year perspective, would be good investment opportunities available in that bucket as well. So I think these 3 or 4 buckets are the one. And obviously, I've always been slightly more bent towards B2C businesses. If you look at the portfolio also, I think it's heavily skewed towards consumption. And I continue to believe that a lot of scope in the discretionary space still exist, given low penetration levels in a lot of categories. a lot of industries where there is scope to gain market share for some of these players from unorganized guys. So yeah, so consumer discretionary would also fit into that space.
Thanks, Rajat, for sharing the insights on the scheme and walking us through the portfolio construction process, investment philosophy very elaborately, and also on where we are seeing opportunities in the market today. Thanks a lot for your insights.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.